early this morning, and we see the S&P 500 up just about 0.3%. How do these levels look to you on stocks?
Yeah, thanks very much for having me, Kristen. These levels do actually make a lot of sense right now because we do have an expectation that, first of all, inflation is coming down, and we do have an expectation that the Fed will begin to raise rates eventually. So stocks are responding to that. They're also responding positively to tariffs. Tariffs were an issue earlier this year because there was uncertainty in the market. And now we're seeing that the tariffs actually aren't causing that much of a stress on a lot of companies.
Interesting. Now, of course, a lot of focus into that Fed decision next week, Steve. How do you think the Fed responds to what the current environment is telling us?
I'm actually up in the air on what the Fed will do. I know I'm supposed to come on and say they're not going to raise, they're going to raise, but it's been very difficult to judge this particular Fed. I do believe that rates should come down on the short end, primarily because if you look at the curve of the current Treasury curve, that the 10-year is at basically the same rate as the short end. So the market wants 10-year at about 4.5%, 30-year at about 5%, 5-year at about 4%. But the Fed is being very stubborn and holding rates at 4.5% on the short end.
Yeah.
So we want that short end to come down to create a natural curve again.
Yeah. What do you think this earnings season will reveal? What do investors need to take away from these results and guidance from these corporate America CEOs amid changes to trade policy?
Well, the primary thing that I'm worried about is consumer sentiment. We are seeing things like hotel bookings, restaurant bookings, bar bookings, even airline bookings coming down. So consumer sentiment has dropped in areas of expenditures that are outside of the normal budget. They're struggling to pay credit card bills. They're struggling to buy groceries, to pay the mortgage, housing. The cost of buying a home is now higher than it is in 2007. So I'm really concerned about consumer sentiment here. So I'm watching that data point the most as I'm looking at stocks going into the Christmas season.
Interesting. So the Fed has called consumer sentiment soft data, not necessarily the hard numbers. In fact, the author of the Consumer Sentiment Report out of the University of Michigan joined us a little bit earlier in this show, Steve. What about those inputs in that report make it so determinant in terms of where we go from here?
Well, one of the things that we've seen really in the stock market is that the top 10% of earners are the ones that are driving things along with institutions. The bottom 90% of earners are not buying stocks anymore. So that's the group in particular that is struggling with high debt, whether it, again, on mortgage, on auto. So without that spending, it's going to be a tough season. So I'm watching very closely where, most consumers are buying, right? So whether it's discretionary or non-discretionary goods, those are the things that I'm watching very closely. So I'm actually watching that Michigan Fed report very closely.
All right, Steve McClurg, CEO at Canary Capital, joining us from Nashville this morning. Steve, thank you.
Thank you.